Hello, friends. Welcome back to Great People Interview Series. Today, we're going to be discussing something that's so important for all of us. Yes, where we keep our money, which is bank, right? And we'll be discussing about digital banks, how are they evolving, how are they shaping, and we have probably the best guest that we can have on this, who is an expert, comes from a very traditional banking background, and today he's set up and is a founder of the company C Innovation. Xavier, welcome to Great People Interview Series.
Thank you very much. Thank you for that great introduction.
Uh, I'm really impressed with the kind of work that you do at C Innovation. Um, we are still admiring digital banks and how they're shaping, but you are one step ahead. You are an expert advising digital banks where to go from wherever they are right now. So you are actually giving piece of advice to these banks, which is fantastic. In nutshell, uh, just tell us what you do and what C Innovation is into.
Perfect. Okay, thank you. Yes, I mean we built, as you mentioned. I have a banking background. I work in the UK. I work also in France and in Colombia with banking institutions. We set up Innovation now 6 years back to help and understand the fintech environment, the digital banking, the neobanking at that age. So we work with different kind of institutions, from big banks to fintechs and digital banks, neobanks across Europe, the US, and Latam. So basically, we provide insights. We have a membership subscription, but many of our work is more bespoke. So we have institutions that come to us asking for specific insights, different areas, wealth management, digital banking, BAPNL, and we provide the insights if it is to where to play, which market is more attractive, which products, who is leading in a specific sector. That's the kind of work we do. So help them to prepare better to deal with their strategy going forward.
Fantastic. That's really amazing and exciting time as well. So that's really wonderful. I think we are all excited about digital banks and how they are so dynamic in nature. Things are changing almost, every few weeks in this market. So I understand, why these banks would need an expert advice from people like you. But how do we really understand from the audience perspective? So let me set the scene here by talking about the topic that we're going to be discussing today: how digital banks are evolving from growth led expansion to regulated, profitable platforms. That's the topic today. And let me begin by asking, what is the biggest leadership shift digital banks must make to move from wherever they are today, which is growth led scaling, to regulated and profitable? What is that shift that is required?
Okay. Just let me go maybe first to the main question about how digital banks are evolving, and I think that could give us some background in terms framing what they need in terms of biggest leadership shift. I think we need to recognize something that is quite important, that digital banking is entering in a second phase. So the first phase that was all about the scale. So about getting customers very quickly, getting them on board with a single product normally. And the second phase is all about a structure, and that's a shift that changed everything, and that's where we, as innovation, are focused at the moment. So let me just go to the first era of digital banking. That was the growth era. So for the past decade, we had digital banks, neobanks were primarily measured by, let's say, some kind of soft KPIs. They were measured by user growth, apps downloads, funding rounds, also geographic expansion, and with that also valuation. So the environment where they were growing in the last decade was supporting that. So capital was abundant, regulation was manageable, interests were also low. So the focus was simple, like acquire user fast. That was the main objective of these digital banks, were having like an alternative to the big banks. So revenue models often depended on interchange, subscription, and light cross-selling of single products. So profitability wasn't often postponed, was not one of the main KPIs, and sometimes it was indefinitely postponed. But that model only worked in specific macro conditions. When we have interest rate that rise, capital become more selective and regulators tighten expectations. Growth alone is no longer enough. And that's a structural shift, and that's what we're seeing at the moment. So growth is no longer enough, and they need to start seeing. We have seen three main structural shifts. So the first one in this second phase of digital banking is licensing as a strategic asset. We have also deposits are more important than loads. And the third one is on profitability through discipline. So let me just explain a little bit of those
Yep.
structural shift that we're seeing at the moment. So in the early years, as mentioned, some digital banks operated under partnership. They didn't. They have lighter regulatory models, and now owning a full banking license is becoming a competitive advantage. So why is that change? Is because as always, licensing has allowed deposit gathering at a scale. Now that these neobanks or digital banks are bigger, deposit gathering is quite relevant. Balance sheet control, lending margin capture, and product flexibility. So regulation is no longer just a constraint; it's become an infrastructure. If we go back to 10 years, maybe 5 years back, many of these players were not proactively looking for getting banking license. They were not in need of that because they covered that through a partnership. But if we see some of the key players like Revolut, they move from operating across jurisdictions with lighter structures to prioritizing full banking licenses in key markets. We have seen that they use the passporting in Europe to cover different markets. They announced last year that they will be applying for a French license market because France is a key market for them. They have applied they have now a banking license in Mexico. They apply one in Peru, and also they got a banking permit in Colombia. So you can see that that's not just symbolic. It gives
Yeah.
them deposit control, lending margin, capture, and regulatory credibility, which directly supports profitability. So I think this is a illustrate how licenses have shifted from optional to strategic.
Fantastic. Yeah.
Let me go to the second one. It's about deposits over downloads. So
Yeah.
user members are less important now than deposit depth. A million low balance users is very different from a smaller base with a strong deposit concentration. What we're seeing, digital banks focus now is in SME deposits, salary accounts, primary banking relationship. That's the goal. The goal is not the app engagement. It was probably before, but it's the economic depth that they can show. So let's take, for example, one player, Quanto, the French SME banking player. Their focus hasn't been mass retail growth. It's been building primary banking relationship with the small businesses, and now they are focusing to serve bigger banks. And just linking to my previous point, they also last year applied for a French banking license. So that shows that the challenges, deposit quality, transaction intensity, and lending potential is very important, and is more important, depth over breadth. And that's another structural difference. And
Fantastic.
just
Yep.
my last part in terms of a structural change is about profitability, and that will help me to answer your question about the biggest leadership shift, because profitability is no longer about adding features. It's about risk adjusted lending, cost control, aid driving, underwriting, governance maturity, capital efficiency. AI, for example, is about improving underwriting precision and reducing cost to income ratios as well. That is very important to improve differentiation on user experience. So digital banks, as I said, that will survive will not the flashes. They will be the most structural discipline. If we go to see in Latam, to Neobank, the real shift for them wasn't adding features. It was tightening underwriting models, improving credit discipline, and focusing on cost efficiency. Their move towards sustained profitability came from balance sheet management, not just product innovation. And that's a maturity signal. So that's the 3 points on the structural shift that we're seeing at the moment. So licensing as an asset, deposits are very relevant, and also profitability. Now
Well, yeah.
yeah, I take back to your question on what is the biggest leadership shift for digital banks. So I think the shift is moving from a mindset of growth to an infrastructure mindset. So all this structural shift that we mentioned is something that, talking to some people in this, I think in the early phase, they keep focus on user acquisition, funding rounds, and market expansion. But today, leaders more think must think like regulated institutions. So think about capital allocation, risk management, governance, maturity, and sustainable margins, because scaling a digital product is not the same as scaling a licensed financial institution. We're talking about Revolut has around 70 million users, much more that Barclays has globally. So, and Neobank is around 130 million, one of the biggest institutions in customer numbers in Brazil. So the leadership discipline required is fundamentally different. So the transition, for example, from Revolut to securing an operating signing a full banking license in major markets reflects that shift, and it's moved from platform scaling to institutional scaling. And the leadership discipline required a fundamentally different perspective.
But I think that, having said that, I think that's fantastic, detailed approach that you have explained. And we get the three layers and 3 points to ponder on. However, if the digital banks are moving to get the full banking license, etc. So they are pretty much moving to the traditional banking. So my question is, will they not lose the reason why they exist in the first place? Because digital banks are faster. Well, they're faster because they are less regulated. So they can make decisions like private companies, right? They are easy to deal with because they have less terms and conditions. So now, when these digital banks they go and acquire full banking license, will it not affect their fundamental reason for the growth?
Okay, that's an interesting question. I think they are in the second phase. So because their phase one was about growth, and as you mentioned, it was user experience quite easy. They started with a single product, maybe with a relationship with a bank, and just having users was the first objective. Now that they're getting the full control of the balance sheet, that they are getting the licenses, I think I don't see that that means innovation, let's say, a slow down or will stop. I think actually innovation in this new era will be more intelligent. In the first phase, innovation was quite future led, and in the second phase, innovation must support some of the key areas of banking. So we're talking about regulatory compliance, margin improvement, capital efficiency, long-term trust, and innovation doesn't improve economics won't survive. So I think they will continue going into their style is still digital. They don't have legacy branches and old technology like some other banks. But I think the winners of this second phase of digital banking will those that integrate technology, license, balance sheet, and governance. So I think the innovation will keep there. They will keep with the main objective of changing
Right.
banking, but it will be more intelligent, more focused on innovation that supports the second phase of their growth.
Right. Yeah. Well,
Makes that sense?
yeah, yeah. I think I'm just thinking that in that case, how is regulation now reshaping the product design, the technology decisions, with perspective, from digital banks?
Yeah. I think in the first era, regulation was something that you comply after launch. So you launched the product, you had your partner, and then you take care of regulation. It now shapes now regulation is shaping product architecture from day one. So for example, lending products must integrate underwriting discipline early. AI, artificial intelligence systems must be auditable and explainable. So cross-border expansion requires regulatory perimeter planning. So this is a lot of technology decisions that needs to support risk, transparency, data traceability, and also capital efficiency. A good illustration is how digital lenders in Europe are tightening credit models. They tightened credit models after the post-pandemic growth. So prioritizing portfolio resilience over approval speed. So regulation is becoming embedded into infrastructure, no layered on top. So I think that that's the key uh, point, that in the structural shift, regulation will be shaping a product architecture from day one.
Wow. Well, in that case, regulation is a key factor now. So, the obvious question is, and probably one of the most important question for those involved in digital banking, or in the startup stage of digital finance, fintech platforms. I think the crucial question is, what is that revenue model for digital banks that is scalable in this regulated environment, and what is that revenue model that, in your opinion, will not survive?
Okay, great. Yeah, I mean, we did last year a piece of work with innovation. We took almost around 30 digital banks in Europe, neobanks, digital banks, and we ranked them by profitability, deposit depth, customers, a lot of different KPIs, more financial rather than just on growth. And I think what we found is that interchange heavy models without balance sheet depth are fragile. So those that they still are working on that phase one of digital banking, focus on subscription only models, struggle in customer engagement. If they struggle if customer engagement drops. So the most scalable models are those combining a strong deposit base, risk adjusted lending, SMA banking relationship. That's key, and that's why you see a lot of retail that started digital banking in retail are moving into SMA banking relationships, and also structured credit capabilities. For example, a new bank profitability journey has been driven less by future expansion and more by credit discipline, as we mentioned before, cost efficiency and margin optimization across its lending portfolio. But if we look to a more fragile structures, consider those digital banks that rely primarily on interchange from debit card usage. They started like that. If they haven't evolved, there is a quite big risk. High marketing spend for customer acquisition, minimal lending exposure, and limited deposit monetization. So if we move in a low rate environment, that model can survive. But in a high rate, capital discipline environment, more regulated, it will struggle because margins are thin and growth funding becomes more expensive. So the key issue is not whether a model works in ideal conditions, it's whether it works across cycles. Revenue must be supported by capital structure, not just transaction volume, and models dependent purely on growth velocity without margin discipline are unlikely to survive long term.
Right. Well, that's really deep and quite bit to understand. I'm sure we probably have to see uh, that you have actually analyzed 30 different banks, and you have come up with some statistical analysis, and you're just spelling out the conclusions. So it looks pretty thorough in what you say. I think probably the digital bankers need to digest this and probably revisit their strategies and see how they can apply these changes. I'm sure it's very easy to say but difficult to do, um, because if you're already running in stage one, how do you then transition yourself into stage two? And you have to take the appropriate steps. So I'm sure you're an expert, and those digital bankers will probably reach out to you if they're watching this interview, I'm sure people who have the curiosity will probably reach out to you for more insights. And this is just an interview, so we have limited time allocation. Um, but maybe this needs a more detailed workshop to go through different parts of the kind of areas that you mentioned, and analyze and see how my digital bank, my fintech platform can adopt these changes. And I'm sure there's a lot to this than just talking about it. Having said that, let me just ask one of the last questions is, you know, uh, what are some of the challenges that you see, your kind of businesses facing right now, where you're actually trying to help digital banks and navigate through this fast moving technology world? What are your challenges?
Okay. Okay. Our challenges. I think. I think we are very well positioned out there in Europe. We don't use much marketing spend, or I think the main challenge that we have is get to the right person, right? To the person that take the decision. Sometimes big banks, it takes a long time to take decisions, and it's a complex, let's say, decision taking process. But I think from our perspective, we're doing, a very innovative research. We're well positioning. We understand well the market. I think our challenge now is being to get to the right person and get to know, see innovation out there better, widely across Europe and some other key markets, Latam and US, which are quite interesting for us as a business.
And finally, what is your advice for the entrepreneurs? Well, those who are in the digital banking space, as well as those who are uh, just entrepreneurs outside digital banking space.
Okay, I think from my perspective, and just with the discussion that we had about digital banking, I think that the key lessons that could apply for both entrepreneurs in banking and outside of banking is that profitability is not the opposite of innovation. So it is a validation of innovation. I think for a long time, maybe we see that very different. And I think in digital banking, and many other markets, the players that are succeeding are not those who stop innovating, but those who align innovation with capital discipline, in the case of banking, regulatory ownership, and also economic sustainability. So long-term trust and durability now matters more than speed. So the institutions and entrepreneurs that understand this early uh, are building platforms that are designed to endure economic cycle and not just funding cycles.
Lovely, lovely. I think that was a great piece of knowledge to have, and I'm sure audience is going to love this topic and love the content that we just discussed. Thank you so much for your time. It's a really pleasure having you here.
Thank you very much. It was a pleasure.